With bond yields rising, equity market volatility returning, there's been a lot of discussion around late cycle investing, particularly from the US perspective. In this video, we're going to have a look at some of those issues. We're going to investigate previous late cycle phases of the US economy. But basically what we'll be showing is that no two late cycles are the same, and therefore the implications for investment markets can be quite different. So in this first chart here, what we're looking at is the unemployment rate relative to the estimate of US NAIRU. Now we recognize that estimating the non-accelerating inflation rate of unemployment is a difficult concept, but we are going with the current number, and it suggests that in the current environment about 4.5. So as you can see in the chart here, US economy now arguably in what we would call late cycle, and the shaded phases on the chart represent previous late cycles. So you can see the chart going back to the late 1940s. Now, if we think of that in terms of those particular late cycle phases, so regimes, we've called the late cycle regime up here, and we're looking at what has happened to the unemployment rate relative to NAIRU. And so what might become fairly clear here is the range of outcomes, but probably more importantly, the duration of late cycle phases. They can be as long as we experienced in the 1960s, for about 66 months, and as short as around about 12 to 15 months in this period. And these are the range of outcomes. In the 1960s, unemployment moved something like 2 to 2.5% below what was estimated to be NAIRU. The current phase is the black line, suggesting we're about 90 basis points below NAIRU at the moment. So you can see those cycles are quite different. So if we define this as a late cycle phase, as judged by the comparison of unemployment to the NAIRU, here now we're looking at the path of Fed funds rate in basis points terms during those phases. You can see the average is the dotted red line, basically the average after, say, 12 to 15 months, which is roughly where we are at the moment. The black line, about 150 basis points, but there's been quite a significant range of outcomes from basically flat at around about this stage of late cycle, 15, 17 months in, to as much as 400 basis points tightening. So we're sort of in the range of outcomes. But probably more interestingly is to look at the equity market and what's happened in previous late cycles. And so, and again, I should stress we're defining a late cycle as periods where unemployment goes through NAIRU and is continuing to decline. So in previous late cycles, you can see here we're now roughly 15, 17 months in, markets up 25% over that period. And that is about in line with the average. And in fact, the range of outcomes for this stage of the cycle has typically been 20 to around about 45% increase. So you can see we're in the ballpark. So these late cycle phases for equity markets have generally been quite good. People talk about the volatility, and sure, that is something that has occurred. What gets interesting though is where to from here. And so if I now basically push forward, let's push forward about 14 months. So you can see now, we're roughly, this is where we're at the moment. I've got about 2 months into this period now. This is where the outcomes start to diverge quite considerably. You can see from this point on, so 15 to 17 months into the late cycle phase, we've had a couple of events where the market has turned down quite decisively. Certainly the early 70s. We've also seen, I think this one is 1954, but a range of outcomes where it's been stronger. So certainly a lot greater divergence from this point, begging the question, have we seen the best of the equity market returns given where we are at a more advanced stage of the late cycle? So we've identified the 1960s, the 1997 and 1954 as being three of the longest late cycle phases, and also probably three of the best performances from equity markets. 87, beginning 87 onwards was also quite strong, but they were the three longest and perhaps strongest cycles, late cycle phases that we've seen. So what are the characteristics of these longer late cycle phases? So perhaps a good place to start is to look at inflation. And what I'm looking at here is just the headline CPI, and what we find on this chart, this is a cumulative increase in the CPI. So this is the 1960s. You see the blue line, quite a low, slow, gradual increase in prices. Inflation remained low for a time before starting to accelerate later on in the cycle. Likewise, in the 1950s, a very sort of low growth rate in prices. And I guess the current episode is around about in the middle of the outcome. Certainly nothing like some of the outcomes in the early 70s where you saw quite short, sharp increases in prices, and they were associated with shorter cycles. So let's look at, was it wages that was the reason for this? And I'm going to use compensation per hour. That goes back to the 1950s. And again, you can see here that in the 1960s, compensation per hour was quite low through this period, as it has been in the current episode. So perhaps that augurs well for inflation staying low if this can be maintained, and therefore elongating the late cycle phase. But it's not entirely clear, because in 1950s, wages growth actually picked up quite a bit more. Even in the 1970s, I think, oh, sorry, the 1990s, you also saw a reasonable pickup in wages. So it didn't seem to be necessarily a wages outcome. But what really seems to be important is what happens to productivity. And so what we're looking at here then is the path of productivity in previous late cycle phases. You can see it's very strong in the 1960s. Productivity was up, close to 9% over the first 24 months. It sort of slowed a little bit after that. Wages growth started to exceed productivity, and inflation took off. But certainly in the early phases, productivity was strong, as it was in the late 1990s also. So on two of those long late cycle phases, constructive for equity markets, inflation stayed low, not necessarily because of low wages growth, but predominantly because of very strong productivity growth. And I guess it's in that light that we look at the current cycle, and the black line here showing that productivity growth as measured officially remains very, very mediocre, and that doesn't augur well for keeping inflation in check. So that's certainly one area of key focus for us going forward, in terms of at what point or how close are we to the end of the late cycle and the beginnings of an early downturn, which is of course the worst period for risk assets generally. And one of the main focuses there will be what's happening to the productivity and wages trade-off, and therefore inflation pressures. Just very quickly, a quick comment on Australia. So we did look before at the unemployment rate versus Nauru for the US. What does it look like in the Australian context? This has been a bit of discussion through the Reserve Bank just in recent days, and it's worth revisiting here. So that's now the pink line, and I guess we don't have quite the extent of data as the US. What we do find, though, it does tend to follow the US cycle, as one might expect, although there was a severe breakdown really from the early part of 2000s, when Australia unemployment rate went a long way below what was estimated to be Nauru during the mining boom and associated strong economic growth here. And it never obviously deteriorated to the same extent as the US did during the financial crisis. And with the unemployment rate falling to 5%, arguably in line with the current estimate of Nauru now, we are sort of lagging the US economy. One might expect that estimates of Nauru, as they probably will for the US, come down as we go forward. So thank you very much.